In this video, I'll be walking you guys through two option trading mistakes that I've done on my meta position, which will hopefully help you in becoming a more consistent, profitable trader, or if you're not profitable yet, to become profitable a lot faster. So for context, I own 100 shares of Meta, and you can see here my unrealized P&L is nearly $20,960, which is absolutely fantastic. My cost basis is $140. So I got assigned a put at 140. It does show an average price of 128.2. I've been selling covered calls, I've been selling puts, all these kind of different things. So it takes all of that premium that I've gained into account as part of my overall realized P&L. So I picked up 100 shares at the 140 cost basis strike when Meta was declining from its highs of around 350, 360 last year. And when I got assigned those shares, I started selling covered calls at $160. So I was doing weekly covered calls, which is one of the first mistakes about the time frame of when you do covered calls, but we'll talk about that one in a second. And as you can see, Meta just kept falling. So as Meta kept falling, I wasn't making enough premium to sell covered calls at the 160. Because you can see here that it got to a low of around $85, $90, I think Meta did, where it eventually bottomed up and then we had the V-shaped recovery. I started selling covered calls below my cost basis. Now that is the first fundamental flaw. I don't do this anymore. But when the market was dropping, I couldn't really pick up any other premium any other way. I was taking a risk in selling covered calls throughout below my cost basis. And as it was dropping into the 120s, the 110s, the 100s, it was working out for me because the price kept falling. It wasn't challenging my 100 call, my 105 call. It wasn't challenging those strikes. But as you can see, with that V-shaped recovery, the challenge is, and this leads me on to my second options trading mistake, is selling covered calls on a weekly basis. Now, when you sell covered calls with a short duration or short days to expiration, and the price moves violently against you. So in my case, the price went up. The same concept if you sell weekly puts and the price drops dramatically in a short space of time. It's very difficult to roll those options, and in my case, up. So up in strike and out in time. So what I kept doing was kept rolling for another week. I think I was at the $90, $95 covered call, and the price shot up to 105, 106. My thought process is I will keep it at the same strike for another week. Meta will have to pull back eventually. It's been in this massive downturn. This just must be one of those fake out rallies. And I did that for such a long time. I think it was at 120 and I was still rolling the 95 call, picking up 10, 15 cents of premium. And the price just kept going up. So the price started getting away from me where I was like $20 in my cost basis. So I thought to myself, I need to come up with a plan here. Firstly, to get me back or get my strike back to the $140, which is my cost base. Because if I can get back to 140 and the option expires worthless, therefore I just lose my shares. I keep all the premium I've collected, the classic wheel strategy approach. So what I did is I was selling covered calls, but what I did is I went further out in time. So therefore I had more extrinsic value. So therefore I was getting bigger premiums or paying less of a debit. And let's say I had a debit of, I don't know, $1 or $100. I would sell a put above my call strike closer to the current price to make up the difference in the debit. And those worked out for me because the price kept going up. So eventually I was able to get my covered call to the 140 strike. And it didn't cost me anything because I kept putting puts on to cover that debit that I was paying. So fast forward to today, you can see here at the bottom that I have a January 19 160 call. Now, if I look at that 160 call, you can see that this call is down 17,962. So I was at 140 every monthly cycle at 21 days to expiration. I roll up by $5. Now, if I walk you through this now, hopefully this will start to make sense of what's actually going on behind the scenes. If we take the December cycle rolling into the January cycle, so the January 19th, which is where we are now, I had the 155 call expiring on December the 15th. We got to 21 days a few days ago. I rolled from the 155 call to the 160 call. Now, effectively, I'm buying back $5 of intrinsic value, but because of the extrinsic value in the time, so I think the time is about 45, 50 days away till expiration, I was able to not only pay a $5 debit, I was able to pay a $4 debit. Now, because I already own the shares at 140, so moving from the 155 to 160 should in theory cost me $5, but it's cost me $4. So therefore, synthetically, I'm actually making $100 in this position because I'm buying back the intrinsic value of $5 with the cost of only $4. What this is doing now is every single month I'm rolling up by $5. So I'm buying back $5 of intrinsic value, but because of the extrinsic value that's still in the option that I'm selling, paying around $4 or $4.20. So I'm making $180 to $100 every single month on this position. So I'm crawling back or phasing or stepping up this call that started around the 85, 90. I was selling puts to get it up as far as I can to get it to 140. Once I got it to 140, I stopped selling puts because even though I'm buying back the intrinsic value, I am still basically going to get this back because it's already in my shares because I'm above my cost basis now. So the good thing is that once I sell out this position, my shares will get called away at 160. I bought them for 140. I will make a $20 or a $2,000 gain on this overall position. So the first key was to get to 140, and now is to roll up $5 every single month. Now it's going to take me a very long time, assuming Meta stays around the 330 or even gets to all-time highs around 360. If I'm only rolling by $5 every single month. Now, if we roll this back into the two options mistakes, again, selling covered calls below your cost basis, in my view, just don't do it. Like I've learned from my mistake, I'm just not going to do it. The second thing is trying to sell options on a weekly basis. It's just not worth it. Like research shows that your average P&L is going to be bigger selling weeklies versus monthlies, but you're picking up 8 to 10 times more risk because your gamma increases as your days to expiration goes, and gamma is your acceleration of your delta. And once your delta gets pretty high with only a short time frame left till the option expires, it's very hard to roll that option. And you guys have done it before where you sold like an option with only a few days to go and you tried to roll it and you got to roll out for 6 months, right? That's why I stick to monthlies, roll at 21 DTE. I really hope you've enjoyed this video. You got some value. Please like, subscribe, and comment, and I shall see you guys on the next one.